Hi, everyone. Good to have you here. The next VC on our AMA session is Sunil Goyal. He runs YourNest Venture Capital. YourNest is a very sharply focused pre-Series A fund that was established in 2011. The goal is to nurture global market leaders from India. It invests in technology led, enterprise driven B2B and deep tech startups. They have completely invested their first fund, and it's currently raising and deploying from its second fund of $45 million, dollars, especially in Indian startups with a focus on deep tech. Few of their notable investments include Orbo, Mompresso, Aria.ai, as well as recent Dosi and Mikko. Um, I'm I'm happy to invite Sunil Goyal now to talk about the fund as well as introducing their thesis and themselves as to how they think about making their investment. And then we'll start taking the questions from the users. Thank you.
Oh, thanks, Rajat, for having me. And my day is made. You made me join around 10 minutes early. I could listen to Sandeep and the kind of lessons that he was sharing with all others. Thank you for that. Uh, Looking forward to an interactive session. And let me start. My first exposure to venture capital was in 2001 when I joined Bharti Airtel. And I fondly remember when Sunil Bharti Mittal happened to negotiate a $500 million round. And while we were negotiating, how attractive he made the proposition for investors like Warburg Pincus to come in. Within the next 4 years, they happened to make 4x return in dollar terms. $300 million became $1.2 billion and they exited fully. In a way, that was a happy situation. But for me, it was one of the biggest problem statements. It was a pain for me in a way. Why was I saddened? Not a single penny of that return was made by an Indian domestic capital. You know, telecom had to be a large market. It was an early stage investment. There are vulnerabilities when you are investing in early. However, it came clear that by 2012 that YourNest needs to come in to pull the domestic source of capital to encourage startups at the early age and participate in their growth when everybody else is thinking that there are too many risks. We decided to become the first institutional investor, sharply focused, as you said, on a pre-Series A stage. As the time went by, we started, okay, in the 90s, when we went to the investors, we told a story that 1990s was about IT services companies creating value for investors. 2000 was about mobile. And the decade of 2010 is going to be about mobile internet. Hence, we started investing in the spaces like content and commerce. One of the biggest lessons were learned by us. The market actually, slapped us. And what was that about? Content commerce was a big daddy's game. It was a game wherein the capital was the core differentiator. And with a small fund like us, it was very, very difficult for us to stand by some of our companies when the competitive scenario changed and market became tough. This made us rethink on our strategy. We had to be very, very careful and vigilant while investing in anything that is much more to be driven by capital. Come 2014, India was shaping up towards becoming a product nation. This was the time when, I would say, these were capital efficient models, wherein enterprise B2B oriented businesses were coming up. We decided to focus on such IP-led product companies, and those days we used to call them deep tech companies. These were primarily SaaS, AI, or AR, VR companies, or IoT-led ventures. While this particular thesis was playing out for us, we happened to learn one more thing during the course from the early experiences. Business of investing is about collaboration. Earlier checks of ours, the 2012 or so, used to be led by us single-handedly. In our second fund, while we led our investments, we invited finest co-investors to co-invest with us. This strategy played out much better. For startups, they had a broader network to reach out with a couple of investors supporting them, and the access to capital multiplied. So this was one core differentiator that the second fund happened to see. While we are now conceptualized to invest for the next decade, one of our mentors, my mentors, is Manoj Kohli, who is the country head for SoftBank in India. For 2020, his slogan is Decade of Digital. And in the decade of digital, it is going to be all about how the data, the right set of data, is used for using AI. It could be generated from IoT tools, or it could be a data source from the real world examples or real world learning of the AI tool. We believe India is best poised to now support AI native startups. Now, what do you mean by AI native startups? These startups wouldn't be in existence in case AI was not there. That's the first parameter out there. Second parameter that we're looking at is that it is the product first engineers who are co-creating this startup. These engineers have never worked in any IT services companies. They have been taught and brought up by large corporations by working in their product teams and seeing and experiencing how product strategy scales up. There was one study conducted internally. There were 87,000 LinkedIn profiles in India and 9,000 plus job openings for product jobs in the country. Today, if I have to say in simple words, we are looking to invest in product innovations, IP-led companies, clear focus on the companies that can compete with global giants and actually serve clients globally. Today, when we look at some of our portfolio companies, whether it is Mikko, Dosi, Level Networks, Arya.ai, etc., they have global customers. They are serving the needs whatever positioning they've got. That positioning is enabling them to be able to either create a new market altogether, or be known amongst the top market leaders, global market leaders in that segment. So this is what we are trying to do at YourNest. To close it, we are 5 partners, with 3 being the techies. One is people person, and I myself is a business guy. This fund was conceptualized only when Sanjay Pandey said yes. He is the one who actually, looks at the motivation levels of the entrepreneur and how you are selecting a team and building talent and pulling talent into the team. Once he came on board at a pre-series A stage, it is all about assessing people and team. And then we added 3 core techies onto the team members, a 5-member team. Now, while being a 5-member team, we only invest in 2 to 3 or 4 startups in a year. This has been our norm. In the last 8 years altogether, we had invested in around 22, 23 companies until April of this year. This April, it was a challenging situation. It was a lockdown time. Most of the VCs said that they are not going to be writing checks. And here our team came by and we were listening to their opinions, and we deliberated that we have cash in hand. Our companies are going to be surviving through the next 6 to 12 months. We launched the India's first fast track funding program during the pandemic in the month of April. And within 2 weeks, we got 2,000 applications. What I'm happy to report is first time in 1 year, we happened to sign 7 companies in 2020. So that's the background. With that background, I hand over to you, Rajat.
Thank you, Sunil. That was very useful for everyone, I'm pretty sure. So Sunil, in any organization, I'm pretty sure with even a VC fund, what does the funnel look like? Like how many people do you go out and meet every month? Do you meet? What does it take? What does it look like?
When we look at our weekly deal flow, if you have not attended any conferencing or accelerator or incubator meeting, normally it will be 40 to 50 deals. In the time when we've attended any demo day or so, that week we will have around 100 deals coming to us. And from that short list, every week the IC gets to meet around 4 to 6 companies. Now 4 to 6 companies are deep. We took a deep dive. We look at what are the fresh set of companies that are coming onto our deal funnel. Let's say 4 companies have come in, and those 4 companies, 5 partners spending lots of time interacting with those companies in that particular week itself. From there, normally it'll be one company eventually getting into a deep dive kind of stuff. So let's say a deep dive will be happening in a year in around 40 to 50 companies. Of that 40 to 50 companies, we have to now see whether we're able to invest in 4 to 7, 4 to 8 companies. That'll be a great score for us. So that's the kind of pipeline. So at any point in time, you will say that we will have a pipeline of 10 to 20 companies to be reviewed.
Very interesting. So it's a game of attrition in a way, from an entrepreneurial perspective.
We have to learn to say no faster.
So let me ask you this, and I think this question has been asked. Yeah, I do know. I do understand that. So one of the person who has asked the question is asking about what is the right stage at which they should come? Is it pre-revenue? Is it idea stage is okay, you are game for it? Or now that pretty much everything is technology driven, especially your fund focus is more tech driven. So the proof product should be there, some early revenue should be there. What's the stage at which they should come? And what's the check size that you guys typically invest?
See, typically in a pre-series A, we would be investing around 600 to 700K. These days, normally if a co-investor is there, the round could be $1 million, $1.5 million as well. So all together, preference is 600 to 700K round. The stage that one has to come in, see, we are a venture capitalist. As a venture capitalist, we have to minimize some amount of risk. And the minimizing of some amount of risk is that you should have your technology in place, and we should be able to at least speak to one customer who may not have paid for the services at all. This is a customer who is helping you to co-create the market. This is the customer who is the one who is saying there is a market for it. He has some idea of what price points he'll come in when he comes in. most of the companies that we've invested in normally had first revenue coming in after a check has gone in. So uh, there are some pre-product companies that we invested in, but that was an exception. It was done only in April 2020, because we knew that even if we invest in a product, a ready product company, we can't go to the market for the next 9 to 12 months because the pandemic lockdown is there. So that was an exception. Nowadays, we're looking at always a company wherein first customer is ready to sign up and come on board. The purpose of a pre-series A is that once we've invested in, we should be able to get the technology risk behind for a series A guy to come in. We should be able to somehow say the team is working cohesively in the next 12 to 18 months. That's a second risk that should be behind. And the product market fit. With that, one customer going to 10 customers on a SaaS on an IoT side is going to be one of the best examples for a series A to come in faster. And in that process, we normally look for IP and patents being filed, money is coming in. With our money is coming in, if they can build a base to be enter into a developed market, not enter into a developed market, but at least go there and get their patents established, some kind of understanding of that market they can do, is going to be the other traction for us to be able to see in the roadmap and invest.
Okay, and can we talk about a couple of recent investments? You talked about Dosi and Mikko when we were talking yesterday. So if we just walk through both of these companies, I guess one by one, and do a little deep dive into how you went about, figuring out which company to invest in, or selecting these companies. Like what stood out? Like it's a fairly rigorous process, right? You're meeting a bunch of companies, you're filtering them on a daily basis, weekly basis, then in-person meeting, then deep dive, and even after deep dive, you're selecting 10% of those companies. So what stood out about Dosi and Mikko that made it through? And because I think for entrepreneurs, getting an idea of what drives this distinction will be really helpful.
Good point. Actually, let me start with Mikko. The introduction to this company came to my partner over a family dinner, and the other VC happened to talk about that this is the kind of company, and very difficult for us to make an assessment on the tech part of Mikko. It's a robotics company, and we jumped on the opportunity. We said, boss, we understand every bit of it. Tell us as to how do we go about it. And while the assessment was going on, in a way, one could have positioned it as a electronic toy. You may name it as a robotics company. Somebody may say it's an electronic toy, and why should you be investing in it? On the other hand, in the US, there was a competing product by a company which had already raised $140 million and was valued at $700 million.
Wow.
Here is a company that we are evaluating for pre-series A to invest, $1.5–2 million, and evaluating whether they can stand that competition. The best part was we happened to go through the product roadmap of the next 5 years, step by step, every product launch. And when we went through the product roadmap of that particular company, it was already, these guys had already won multiple robotics competitions worldwide. And with that product roadmap, we could establish that they have the clarity and wherewithal to be able to launch a product better than this company. Sadly, or in a happy situation for us, that company could not launch the product. And they wound down. The $700 million gorilla happened to wind down by 2019. Our product did well in the market. But while we were assessing that particular stuff as to why it was only the product roadmap that worked for us, today they have customers in 90 countries. They are the one who are Okay, the other element was it was an emotionally intelligent robot. It could dance with a child. It was a companion who could read the facial expressions. It had an AI with around 35, 40 sensors to be able to walk around, follow the child, to be with the child, to take care of the development needs. So there was an assessment that this product is to be positioned far, far superior than any particular toy. And those days, in a launch like this, Soha Ali Khan was launching this product, and I went to her and I told her that Steve Jobs launched iPhone in 2017. Mikko is launching this product in 2019. It is just 12 years later that India has come to launch a global product which will be available and doing well and creating a new category of entertainment as well as child's development. Hopefully, this thesis should play out. So that's Mikko's thesis. On the other hand, Dosi came along when we were doing our YourNests program. They got to know that we are investing, and this product is about tracking your health vitals while you're lying down on the bed or you're sleeping. This is a contactless tracker, an IoT device, and more like a mini ICU. One, the founding team stood out very differently. I can't share the story out here in full. This founder had lost his hand while saving another child. A crocodile ate his hand away. And this gentleman had some kind of different courage and different positioning that we could see. His tech co-founder happened to, again, win our heart with the kind of AI that they were using, because they're hearing it's for health. It is a promise that in case something is going to be happening to you in 5, 10, 15 days time, it's going to be giving an early alarm. Today, after having seen it, we were the first one to give a term sheet. The moment our term sheet went, we are happy that 2 co-investors came along. And today, 3 of us have invested in Dosi. The kind of lives it has saved. We were in a visit to a hospital in Pune. The Pune hospital said, I'm placing an order for 600 doses because it has saved so much of nursing time for us. And in the month of November, we saved 5 lives. So that's the kind of value a product like this is bringing. Innovation from India, having a potential to serve every home where an elderly is there, or every home in the world.
Wow, that is truly impactful. And when you think about, was that the market validation that really pushed it for you, or was it that was it something else? Like, what was that X factor for that company that really pushed it for you?
Both places. In Mikko, in September 2017, they had launched the product, and we could do the product market fit analysis. By the time we said in our IC, we approved in January 2018 to invest in. Money went in March 2018. So there was a 3 months of data available for us to get to know the product. Even at that time, the engagement levels were 40 times that of Alexa. Very, very important metrics for us to be able to see. And we were seeing that number of kids who are engaging with Mikko even after 3 months was the another market, product market fit for us. On Dosi, it was all talking to the hospitals or the elderly care institutions where this particular product was deployed. And easiest bit was to buy it for you. I happened to buy there and then for my father and started tracking his health. Every day I get alarms and alerts, etc., whatever is required. The moment I saw it, it was, I installed it, I got to know it. My partner, Satish, he was using it for his parents for last 1.5 years. So he was actually the mentor for them at various stages in the incubation centers and other stages. So we had some visibility that without meeting the team during pandemic, we could come forward to sign the check because the founder had interacted with And the other thing is referral of the founder came in even from the founder of Mikko. They were batchmates. So
Right. Very cool.
things happen.
So I guess that kind of tied the two. So I have one question from Naga Reddy Maji,
Yeah.
who is asking whether how does equity work for early stage funding? I think that's one of the questions. When you're raising at an early stage, different funds ask for different things. So can you highlight that for him?
Sure. See, when we as VCs invest in, we would like to come in at a firm valuation of the company. For us, the risk that we are taking, it's not for that, discount to the next round or safe with the 30% discount to the next round for the valuation to be discovered in the next subsequent rounds, etc. No, we are the ones who believe and we understand what should be the value of that business for the kind of risk that you've already mitigated. Normally, for whatever investments we put in, we may get between 10 to 25% equity in the business in the first round. 10 is in a very, very abnormal case wherein many things have been proven by the venture and the paying customers are there. In the second scenario, wherein and a good number of paying customers are there, there is a lot of validation that has happened. Otherwise, normally it is 20-25% share of the equity. If the round side, along with the co-investor, is $1.5 million, you can say one is expecting $5 million of post money. So that's how the equity is valued. The part, it's not a hard and fast rule. We haven't yet gone up to a post money valuation of $10 million in the companies that we've invested in as of now. Are we open? We are very much open. For us, it is about even a smaller share of a bigger pie matters. And our lessons are learned on that count. There is no fun in owning 25% of a company which is not going to be growing. It is better to own 5% of a company which is going to be high growth institution.
Cool. That sounds really great. So one of the questions we have from another person, Makbul, I think we have already talked about it, that um, while it's not the norm for VCs to invest in idea prototype stage, the trend is changing globally. And do you think you will go and invest in idea stage right now, or have you done any such deal where the company was in idea stage?
We've done 3 investments, particularly 2 in 2020. This was in an exception just because it was a long-term period. However, that experience of investing in these product development stage businesses is encouraging. One, it's a smaller set of capital to be allocated at the initial stage. Second, we've been able to hone our skills to be able to identify the entrepreneurs and the technology roadmap, even when the technology is not there. So these are the 2 aspects that give us the confidence to be able to come and invest in at not so idea stage. At least the idea should be, some visibility should be there. Something should have been done on the idea for us to be able to understand how the technology is going to be working. The product launch of these 2 companies is 1.5 years hence. So we already invested 6 months back. It is another 1.5 years. So 2 years of product development cycle is what we are going to be patiently looking at. However, these are global innovations. So let me just alert, these are global innovation. One is in the voice chat, conversational AI. If you want to order a pizza, the machine, without asking you 10 questions, should be able to answer and address in 1 or 2 interactions from you. So that's the one point of voice chat. And this is the biggest problem for baskets and e-commerce and other companies to be able to develop groceries to you in a simple voice call from a customer. On the other side, the second one is in a 5G environment, the edge compute is going to be massive. That edge compute that needs to be happening, there is a high-powered computing power required at the edge, at the data centers, and that particular high compute is being innovated by this particular startup from between Hyderabad and Bangalore. let's see if they are able to develop a solution, a modular chip solution for the chipsets to be using such optical, the light as a source of high-speed compute.
Very
There
cool.
are 7-8 startups the worldwide around that area. So hopefully, there's a difference between investing at idea stage. The idea has to be crazy enough for us to be able to say it'll move the needle for us.
Yeah, it seems like you're going for the moonshot ideas versus just idea to invest in. So one of the questions we have is around assistive technologies. All right. Have you taken a look at any of the companies in this space? Have you specifically made an effort to, find companies in this space? Because a lot of the technologies we are talking about, they're especially in healthcare space or, consuming content space. So I hear the voice assistant from an e-commerce perspective, but there are a lot of assistive technologies available, or there's a potential of a lot of technologies in this assistive space. Have you looked at any of them, evaluated any of these things?
We did get a chance to look at something that was long time ago, okay, a couple of years ago. Now the assistive would be far, far better and far more evolved from what we had seen at that particular point in time. Even in a YourNest SOAR program, we happened to shortlist a few of such technologies. They were in the area of fintech. They were area of those areas largely. That area was very, very prominent in last year. So couldn't put our finger to invest in those assistive technologies at this particular point in time. We are open. If you have an idea you want to share with us, go to our website www.yournest.in. When you fill in our form and submit your application, you'll get to know how we focus on specific technologies. Our form is designed to actually give you an idea as what we'll go through and what will get eliminated in the process.
Very cool. Okay. So guys, you can, if you are in the space, you can go to the yournest.in and fill out the form. It will, you'll get some immediate feedback, and then of course Sunil's team is evaluating them. One of the questions, other questions we had was on gender lens. So, when you're evaluating companies, is the founder's gender part of the criteria in any way? Or are you trying to promote diversity in that particular audience? Or are you encouraging? And I think the second part of it is when these founders build companies, is there a push from an investor side to have gender diversity in their companies?
Very, very good question. See, diversity of any form, whether it is gender, whether it is from cross countries, whether it is people from different backgrounds, it is one of the very, very important criteria when we are investing in. We know every opinion is going to be different. The lens for that particular person to look at the same problem and a solution for that same problem is going to be different. Hence, we always looked at companies. Sometimes we jokingly told our startups that for you to be able to pivot, you need a LGBT kind of person in your team. Otherwise, you guys are not going to be thinking fresh. So, that's one thing that we have told maybe in a board meeting once or twice. For me personally, my first investment was in ZipDial, a company founded by Valerie Wagner in 2011-12, and significant returns. Means as an angel when I led that particular round, the benefit that we got was, as a woman entrepreneur, she got a disproportionate amount of attention from the press and the media. the visibility of the founder is always much higher if you are if you're on a in a space. She was a Silicon Valley studied entrepreneur, so that was another advantage to her. So you get disproportionate share of attention and visibility as well, in addition to the thoughts that you get in. So that's one. In the fund two, we already have two companies where the women co-founders are there. TiE, TiE is the one who is the CEO and the managing director of the company. Practically is our education tech company, wherein Charu is the co-founder. For us, in the evaluation matrix, it was a good positive tick.
Very cool. And I think one more question. This is basically was asked to the earlier Sandeep as well. It seems like the question keeps propping up. Uh, like, have you done, like, there are a lot of ecosystems getting developed in tier 2, tier 3 towns, be it Lucknow, Indore, Jaipur, any of these cities. But given the specific focus that you guys have you seen companies coming out of these areas? Um, have you been able to find time, or in your team someone to be able to find time to visit these areas, foster a particular ecosystem? Have you been able to do that as a fund?
See, particularly the areas that we invest in, mostly the investments have gone in the top 5 cities, I would say, at this point in time. However, for visiting the incubation centers, institutions, we touch base the remotest of the places. Between the 5 partners, if I would have visited Indore, Ahmedabad, Dehradun, etc., my partner would have visited Chandigarh to, remote locations out of Hubli and in Kerala, the other places, etc. So it is an endeavor that whatever government is doing, Niti Aayog and Invest India is doing, by nurturing tinkering labs, by getting incubation centers in place. These are the people who keep inviting us to either to the demo day or as mentors to those particular programs. It is not about essentially getting a deal from there. For us, it's all about nurturing the ecosystem. Today, they may be trying to solve a small problem, but the moment they get to know as to what the investors are looking forward from them, they will start focusing on a bigger problem. Only thing that we tell them, that once you're ready and your venture is ready, your idea is ready, you have the right set of complementary co-founders, please relocate to a market which is closer to your customer. If you can do that, that's the first important stuff. Second is where you can find that tech talent. So it's not about that you've got the idea germinated in Lucknow and you stay married to Lucknow only. If your customers are in Delhi, please relocate to Delhi. And if your tech talent is going to be available in Bangalore, have your presence in between Delhi and Bangalore as well. So it's a mix of advice that goes in, and that's how we look at the opportunity of investing in tier 2, tier 3 companies.
Very, very interesting. And any specific, any company in your portfolio that is currently from tier 2, tier 3?
No,
Not really.
Not. We have a very small portfolio of around 30 companies built over a period of 8 years. So yeah,
very
not yet, not been that lucky.
Cool. So at least, what the feedback is that while there's no blocker as such, people have to move out to a city where they can find the talent. And typically that ends up being the 5 to 6 cities that we are talking about.
Yeah.
And I guess it will take time when the ecosystems will develop enough to support these companies right there where they are. But there shouldn't be a mental blocker, at least from that perspective.
Yeah.
So now switching on to a little bit of uncomfortable questions. So Um,
Sure.
uh, as an investor, you must have invested into a number of companies that may have not really done well. What are the learnings? What are the uh, biggest things that you have seen that causes the failure of your companies?
Hmm.
And of course, what learning from there have you taken to invest? Made the decision to taken the learning from those failures to invest in the future companies.
Okay, as I talked about in my introduction, when we started investing in mobile internet uh, related content commerce kind of businesses, one of our investments was Book My Cab. This company was growing leaps and bounds, very profitable, 15% month-on-month growth, with a small capital injection of 400,000 US dollars by us. Yeah, this kind of growth, profitable company was an amazing scene to see. And then comes Ola and Uber. And we, in our foolishness, never thought that capital is going to be the differentiator, not what you're doing in Hindi language or a Marathi language, or having access to the license to do the Bombay, taxi stuff. First, technology is always going to be growing beyond the regulation. So do not have a hedge against that the regulation is going to be supporting you in any which way. Second learning was that when the money was available, even if you have money in your pocket, go ahead and raise as much capital as possible. It is not about that we have funded you for 18 months. We will talk about the next round of money in 12 months. Whereas Uber was making waves, and we had international investors coming in to meet our founders, and we were saying we have enough money to be able to run our operations, rather than getting those 10, 20, 30, or $40 million checks from them would have been easier and faster and better for us to be able to grow the space. One learning was that in any venture like this, which is going to be needing capital, you need to have multiple investors or co-investors. You can't do it alone. Hence, keep deeper pockets, widen the network. That was the very, very, very important learning. Then, timing is one thing that you can't comprehend. You have to take bets. I can't make out. In 2015, we invested in a company called CDoc. This was teleconsult, telemedicine, comprehensive platform, founded by two founders who had been part of Silicon Valley-based Unicorn, core members of that team, came back over here, started this venture. By 2017, we had to do a fire sale of that particular business. Reasons being, and if they would have been surviving today, it would have been a potential unicorn as of today, in the pandemic times, because telehealthcare and the kind of thing that we have put together, it was so very unique. So timing is one thing that we can't have a control on, and that's a part of thing that we have to always keep in mind, that we will lose some and win some. And when we win, the win is so dramatic. On the timing side, I would say, in 2013, Unifor came to us, and it was a voice assistant. Any language of India, they could handle the calls, and the machine could answer, respond back to the farmer or the laborer, and complete the transaction. For it was amazing that voice is a natural way to communicate, and if the machines can do it, it will grow. Who knew that by the time it will be 2016 and 17, you and me will be starting speaking to machines using Siri and Google Talk, and this will become a normal way to converse with machines. The valuation of that business jumped many, many fold. So somewhere the timing goes wrong, and somewhere the timing actually plays serendipity and multiplies the returns that you have got.
Yeah.
That's that. There is another thing that we've learned. By having invested in this, let's say around 10 companies as angel investor and 30 companies now, one of the frequent mistakes done by the startup founders or co-founders is not having an intersay agreement between them. You normally get a shareholder agreement done only when an investor is coming in. Whereas When you're getting into a partnership, whether it is with friends or people you know, you need to be knowing. One of our mentors from Bharti Airtel happened to teach us, if you are getting into a room of partnership, please also define the criteria of exit. If the criteria of exit is defined and laid down, you will be much more peaceful as partners. What will be the valuation at which the exit will happen? When a company will need capital, at what rate of interest you will contribute from your personal capital? Whether you'll give bank guarantees, give bank guarantees from individual wealth or not. Whether if something happens to you, your legal hire will get a management stake in that particular business or only the shareholding stake. Who's going to be playing the role of a CEO, and what is going to be the delegation of authority of that particular person, or a decision making matrix between the two founders. These are such important decisions. If they are not laid down, normally we have seen some kind of differences amongst the founders come up in a very short period of time. If the business is going under, within 18 months or so, something or the other comes up that this founder does more work, this founder comes less work, I need ESOPs to be able to do it. On the other hand, somebody will say, I gave equal shareholding between all of us, let's say 3 partners, but it's only 2 of us are working, the third one is not working. How do we handle that scenario? So all that can be handled through an intersay agreement, which is a very important tool for you to manage your, startups fail because of founders as well. Can you avoid that one reason, which is amongst the top 10 reasons of a failure of a startup?
Definitely. I think for every startup, having a founder can be a boon or bane, right? For me, in my company, Manoj and I divide the responsibilities, and we have a very clear line of what he will do, what I'll do. And that's really helpful because we're not stepping on other person's toes, as well as he is really helpful in being the sounding board for many things we do. Because as a single founder, it becomes an echo chamber, right? You keep hearing your voice, and every idea starts looking good. So when you have a co-founder, somebody is there. Hopefully, our senior team also does that. That they are, uh, keeping a check on what you're thinking and bringing other perspectives in. So it can work both ways. But clearly, I hear you. I think that's having that clarity of thought and maturity about how to deal with founder issues is very important. And we have seen a lot of companies around us fail because one founder uh, lost the interest in continuing the journey. Thank you, Sunil. I think that will be all for now. We don't have any new questions coming in right now.
Good.
But thanks a lot for taking your time today, for being available and answering all the questions that people had. Um, uh, we'll love to talk to you later and keep picking on your brain as to how you think about doing the deals. But for now, thanks a lot.
Thank you for organizing it so well and conducting it so well and bringing out some nuances from our story.
Thank you, Sunil. Bye.
Bye-bye.